The Fed15 podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our host are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve, and Caitlyn Murray is a financial advisor through Raymond James Financial Services and Director of Advisory Services here at Serving Those Who Serve.
Welcome, everybody, to the Fed15 podcast, presented by Serving Those Who Serve. Each week, we'll discuss the latest news and info that Feds need to know in 15 minutes-ish or less. So whether you're a seasoned Fed or just starting out in your career, Fed15 has you covered. So grab your coffee, energy drink, green juice, whatever. Kick back and we'll tell you what you need to know but might have missed. We are your hosts, Dan Sipe, and I am joined by the incredible, inimitable Caitlyn Murray.
Hi. Welcome back, folks. Back to a new episode of the Fed15.
Indeed.
Got quite a few now.
Indeed. So, Caitlyn, I had kind of an interesting weekend experience.
Oh, yeah?
Fans of the program who go back far enough know that my son actually got a scholarship to go to college to play video games. And, I have parents of teenage boys swearing me to secrecy on that, and even threatening me. But it's true, he did that, and they were at their MAC championships that were in Atlantic City, and had a solid run, played pretty well, didn't get everything they wanted. However, and again, those of you who have listened for a long time, because our original podcast, Fed Life, goes all the way back to 2018, you will probably remember that my wife is a singer. The kids got all the talent from her. And so my son, when he didn't have any competition the next day, decided to walk down onto the boardwalk in Atlantic City and play his guitar and sing for 2 hours.
So cool.
and it's funny. It was a cool experience for me as a dad. And I was talking to him about it afterwards. I said, I'm always proud of you. But this is a case where I have to choose my words carefully, and that is that I admire you, because that's just a lot of moxie. Okay. Mm-hmm. Unless you are a professional, performer, I think the average person who is musical going into that setting, and get this, he made $200. So kind of a funny experience for a dad. Going to Atlantic City for a video game tournament and then watching your son busk.
Yeah, I joked with Dan that it would have to be his son to go to Atlantic City and actually leave with more money than you came with, to earn money while you're there. So
absolutely.
Awesome.
Absolutely.
Yeah.
Well, we have some really interesting topics this week. I'm going to touch on a great article that Jen Meyer, one of our star planners, wrote on the five things you must have in a good federal financial plan. And then Caitlyn will be covering one of your articles. Tell us what that's about, and then you can cover it once we jump in.
Yeah, so it's a very financial planning-esque. We're leaning into the financial planning aspect of things today, more so than investment management or benefits education. But I think it's important to kind of take a wide lens. So Dan will be talking through the five crucial things for a federal financial plan. And then I'm going to talk a little bit about the estate planning angle of things. So the best and worst types of accounts to inherit, so that as you're kind of structuring things for beneficiaries and as you're kind of planning out what your financial plan looks like from a generational perspective, you can sort of have those things in mind, because it definitely does affect how we plan.
Gotcha. Okay, well, let me jump in on the 5 things from Jen Meyer. This could be very high level, but I encourage you to go to our website and hit the blog and find 5 things you must have, because it's actually going to be a series. So I think there's going to be a total of 3. So there's going to be a high level summary here, and then she'll be diving in deeper. So you don't want to miss that. And get ready for a lot of alliteration here, Katelyn, just to let you know. So up first is a cohesive cash strategy. And by that, we mean not just, having some money in the bank, but strategically doing so, making sure that you have shopped and worked to get the highest interest rate that you can on it, but also you are structuring your cash accumulation and use so that you kind of become your own bank. So that instead of playing a credit card company and all credit card interest stinks, I don't care what deal you got where, it's going to end up being high. You're better off not paying it. So you need to have a strategy for your cash now. And since we're starting to see higher interest, it's even more significant. Up next is realistic risk management. And by this, we mean that bad stuff's going to happen, folks. And Katelyn, I know you've experienced this. It still amazes me the number of people are going through their life with insufficient liability protection. And folks, nothing can derail your financial plan, your retirement, your wealth building plan faster than a mishap followed by a judgment that goes against you. And don't tell me you're a great driver. Don't tell me this. Don't tell me that. Don't tell me anything. Okay. Stuff can happen. Okay. So you really want to strategically deploy cash reserves, life, health, and disability insurance, liability protections, because done properly, they can be not only wealth protectors, but modest wealth accelerants. So that's another point. Here we go. Excess alliteration. Prioritize pension practices. If you're a regular reader, listener, attendee of our webinars, you know that we are not from the camp of set it and forget it, get hired, show up until MRA, and just walk out the door. You've got to have a plan for it. And Jen will be touching on some things that people just miss. Okay. Like making a deposit for temporary time, military time, things like that. Having a sick leave strategy. What?
A sick leave strategy.
Crazy. Yeah, this may sound crazy, folks, but you could be in a situation where, gasp, you should be using annual leave instead of sick leave for some of your doctor's appointments, things like that. We'll touch on that. I know everybody's going, Dan, you're nuts. Okay, that's fine. Read the article, see what we're talking about. Again, in the idea of not having set it and forget it, you need a total TSP plan. So you need to understand your ability to tolerate risk. You need to set up your allocation across the 5 core funds. I am not a fan of the life cycle funds. I find that they consistently underweight in U.S. small cap, which is the highest performing asset class. So I can't come up with a good reason to do that. So you want to have a total plan for what you're doing in TSP. Jen's going to talk about that and do a deeper dive. And then the bonus boost, hidden in plain sight. And again, people are going to say, Dan, you're nuts, is one of the most misunderstood and unutilized tools in a Fed's toolbox is the healthcare savings account. Okay, it's like, what, Dan? Like my health insurance? How does that help me? So if you're in a high deductible health plan, you have a healthcare savings account, you're allowed to put money aside. And if that you're allowed to put it aside on a pre-tax basis, and if that is then used for qualified medical expenses, you pay them tax-free. This is the only place I know of in the economy where you get to put it away pre-tax, take it out tax-free. Mm-hmm. So what a lot of people don't know is you're not required to spend it all each year. You do have the ability to invest it. That is an option in most HSAs, to invest it in an allocation, including stocks and bonds, and just let that baby grow. And now everybody's going, Dan, you are totally insane. So I'm paying all my deductibles and copays out of pocket? Yes. Because guess what you're going to spend a lot on when you're retired? Healthcare. And believe me when I say, getting started with this early in your career and maximizing it, you can have hundreds of thousands of dollars that you put away pre-tax and now it's coming out tax-free. So be sure to hit Jen's article. You will not be disappointed, and stay with us for the series because you are going to have your eyes open. So Katelyn, nobody wants to die. but tell me about inheritance in case I do.
Yeah, but unfortunately, we all have to someday. So it's really interesting that actually the last point of Jen's article is the HSA, because it's actually the first point in my article. Now, folks who are longtime listeners of the podcast have probably heard me wax poetic about HSAs before. I have an HSA. I love HSAs. I think they're really awesome accounts. As Dan pointed out, it is the only place that we know of that you can put money in tax-free, take money out tax-free, have it grow tax-free for years and years and years. And you never, if you use it correctly, you never have to send those funds through the income tax loop. However, HSAs do have one nasty little drawback, and I cover it in this article. So we'll start with the worst types of accounts to inherit, and then we'll move to the best types. So HSA is actually the worst type of account to inherit if, big caveat, you are a non-spouse beneficiary. So if a spouse inherits an HSA, if your spouse passes away, you're the primary beneficiary on their HSA, you get to use that HSA as though it is your money because of the unlimited, rules around movement of money between spouses. However, let's say that HSA then passes to your children who are non-spouse beneficiaries. Everything that is in that HSA is cashed out immediately. It is 100% taxable at the beneficiary's income tax rate, and that is a must happen, right? So you're forced to take whatever's in that HSA out. It's obviously not a qualified medical expense, so it is going to be taxed to you 100% as income if you are that non-spouse beneficiary. So this can be a tax time bomb. Does this mean that Katelyn, who loves HSAs, is telling me, oh, don't do an HSA? Absolutely not. What Katelyn is saying is that when we're looking at doing financial planning and retirement income planning, that HSA is probably going to be one of the first accounts that you want to spend down. So if we've got medical bills, if we have, maybe you're early on in retirement and you just go to the doctor once a year, you go to your dermatologist once a year, you don't have a lot of medical expenses, don't be afraid to tap that HSA. And by the way, folks, there's a really cool website called hsastore.com that has all HSA eligible products that you can purchase. It's got stuff like, I think Band-Aids have been taken off. That was an update somewhere in the Secure Acts, but sunscreen is an example. A lot of like multivitamins, I think, can be included there. So hsastore.com, definitely check out that site. Don't be afraid to spend those HSA dollars once you retire, because that is not the type of account that we want to kind of save to pass on to beneficiaries. Another one is out-of-state real estate property. If it's not owned by a trust, that's the big caveat there. It always goes through probate. Probate can be a lengthy process depending on the state that you own property in. It can be a headache for your beneficiaries to deal with. So if you are somebody with out-of-state real estate property, consider talking with a qualified estate attorney about setting up some sort of trust so that you can retitle that property to make it easier for your beneficiaries to navigate. TSP for a non-spouse beneficiary can be a big pitfall. Obviously, you guys know we love the TSP. It is a great savings tool for feds. However, it can be tricky for those non-spouse beneficiaries. So obviously, with a spouse, the money gets rolled over. They use the retirement account as though they were the original account owner. The problem that we have with TSP is when the surviving spouse later passes away and those TSP funds pass to the middle beneficiary's beneficiary. So I've got a TSP. I pass away. It passes to my primary beneficiary. All good. When my primary beneficiary passes away and the TSP passes to their beneficiary, in most cases, the issue that we run into is that they can't roll those assets into another inherited TSP account from my beneficiary's inherited TSP account. Instead, what can happen is the TSP balance is fully liquidated and the beneficiary is forced to take a lump sum distribution. This is similar to the situation with HSAs.
Right.
In the case of a pre-tax TSP, so a not Roth TSP, pre-tax TSP, that means that the entire lump sum distribution is going to be fully taxable at the beneficiary's income tax rate. So it's the same sort of issue that we have with HSAs where they're forced to take that as a lump sum distribution, and it skyrockets their income for that year, which means that a large portion of those funds, end up going to taxes, unfortunately. Right. So if you've got a big pre-tax balance in your TSP, you may want to think through that in connection with your estate planning, because it could be a snag for sure for your beneficiaries. If you have inherited a TSP, maybe your spouse passed away, somebody else passed away, and left you TSP funds, that means that you've already sort of set up that inherited TSP account. So for your beneficiaries, you may want to look into some other planning solutions there. If you've got a professional that you can talk with them, if you're looking for a team of professionals to talk with, absolutely hit us up at Ask STWServe or Ask STWS at STWServe.com. Traditional IRAs are kind of an honorable mention in the worst types of accounts to inherit. It's not necessarily the worst. These are probably some of the most common accounts that are inherited. You do have to, thanks to the passing of the Secure Act and Secure 2.0 to clarify things, inherited traditional IRAs that are inherited by non-spouses do have to be pulled out. All of the assets have to be pulled out within 10 years. And those assets are taxable at the beneficiary's then income tax rate. So, not a terrible situation. You can certainly reinvest those funds in something like a brokerage account, but it's not the best kind of way to approach planning for your beneficiaries. So what is the best way to approach, Katelyn? I'm so glad that you asked, Dan. So the best types of accounts to inherit, we'll start with the runner-up. Brokerage accounts, regular schmegular, non-qualified, taxable accounts, run-of-the-mill investment accounts can be some of the best accounts to inherit. Why? Because of the step up in cost basis. So if I have a brokerage account and maybe over the span of, the time that I've had it, I've invested $250,000 and that account is now worth $500,000. Then what I have is $250,000 of cost basis and $250,000 of gain. If I pass away and leave that account to my heir, then what they get because it's a non-qualified account, retirement accounts do not have this. They get a full step up in cost basis. So their new cost basis is not my old cost basis of $250,000. Their cost basis is the value of the account on the date of my death, which is $500,000. So if they're inheriting an account that's worth $500,000 and they get a step up in cost basis to $500,000, yes, gain is taxable in a brokerage account, but you don't have any gain because you got that step up. So these can actually be some of the best accounts to inherit. That's why a lot of times when people start taking RMDs from their traditional IRAs later in life, if they don't need those funds, open up a brokerage account, reinvest those funds. It'll definitely be, beneficial for your beneficiaries. And then the hands down, in my opinion, best type of account to inherit is a Roth IRA. These accounts, when it comes to estate planning and beneficiaries, these are rock star accounts. Obviously, Roth is tax-free, right? Tax-free growth and tax-free distributions. You pay the tax on the way in, and you've already sent that money through the income tax loop. So when you leave a Roth IRA to a beneficiary, they are getting 100% of that value. Yes, they do still have to take the funds out within 10 years. However, they're not taxed on those funds as they pull it out. It doesn't impact their income. It is hands down, in my opinion, the best type of account that you can inherit. And last week, you may remember I wrote an article on Roth conversions. If you are somebody who is curious about that, we sort of have a golden window for Roth conversions right now, 2024 and 2025. We've got lower tax brackets. If you're thinking about moving money from traditional pre-tax to Roth, now could be a really good time for that. So if you're curious about that, again, our email is askstws@stwserve.com. We would love to talk with you about that, see if it could be a strategy that makes sense for you.
Yes, indeed.
Yeah. And I think with all that being said, I know we're a little bit over our 15 minutes-ish this week, but we had a lot of information packed into this episode for you guys. I think hopefully it's worth it. Hopefully you agree with me. But we do need to wrap up for today. You know that we'll be back next week to bring you all the latest updates that you need to make informed decisions about your career and financial well-being as a Fed.
And be sure to subscribe to this podcast. Hit that subscribe button here on YouTube and also on Spotify if you're able to be a listener and not a watcher, so you never miss an episode. And please remember to share it with your friends and colleagues.
Absolutely. If we could ask one thing of you today in return for free content, for free, financial planning and benefits education, it would be to, forward the show to at least one person who you think might benefit from hearing it. This is a really good kind of episode to get started on. I think it's broad-based and it touches on a lot of things that maybe Feds aren't thinking about, honestly.
Sure, like they'll learn the term regular schmegular.
Yeah, regular schmegular. It's industry jargon there. So for more information on the topics covered in today's show and more, be sure to check out our blog at blog.stwserve.com. If you read the actual articles, they go into a much greater level of detail than we can on a 15-minute podcast. So I would recommend doing that if you've got the time. You can also subscribe to our newsletter, The Weekly Serving, to get all the latest news for Feds delivered straight to your inbox each week.
Absolutely. And don't forget our complimentary webinars every single week. We have some great ones coming up on April the 11th. We've got our tremendously popular TSP webinar that'll go off from 1 until 4. And then on April 17th, we've got possibly our most popular webinar, which is FEHB and Medicare. And again, that's going to be April 17th from 10:30 till 2:30. We do a big block there for everybody.
Yeah, that's a really good one. There's a lot of kind of specific details that we can get into on that one. That's the reason that one's a lot longer. But I find that that's a topic that a lot of folks are looking for clarification on.
Sure.
Well, I think that will do it for us this week, folks. I am Caitlyn Murray.
And I'm Dan Sipe.
And we will see you next week for an exciting new episode of the Fed 15.